Hey, if you've received a notice that your monthly mortgage payment is increasing and you have a fixed rate like most, well, that's likely due to a change in your escrow, your property tax, or your homeowner's insurance, maybe both. In a previous clip, I had discussed property taxes, credits, exemptions, and assessment appeals. You can check that out if you haven't seen it in the description below. So with this, I wanted to focus on homeowners insurance and share with you tips I've learned throughout my career in mortgage financing. So across the nation, something like 5% to 12% of properties do not have homeowners insurance. It doesn't sound like much when you consider there's 144 million properties, plus or minus, across the US. Well, that's 7 million to 17 million homes without insurance. That's just insane. That's an asset that you own, and should it be destroyed in a fire, should you have someone hurt on your property and you don't have liability coverage, well, you're in a really bad spot without insurance. And almost as bad as no homeowners insurance is having a property that's underinsured, and something like 2 out of 3 properties, are underinsured, typically by 20% or more, but as much as 60%. So if you have an event that requires homeowners insurance and it's exceeding your policy limits for coverage, well, you're going to be on the hook for the difference. So I'm going to take a look at those homeowners insurance policies from time to time. Call up your agent and review. You often are going to receive a notice of annual renewal. I think I get mine upwards of 2 months before it actually renews, letting you know of any changes. Typically what I've seen is the change in my premium. They do go up over time. So you want to review what you're paying for, coverage wise. You also want to review deductibles. Take a look at, do you have more than one deductible? Often homeowners insurance might have, say, $1,000 or $2,000 deductible, but depending on the type of claim, you might have more than one form of deductible. It could be a percentage of your coverage. So let's say your home was covered for $400,000 and you have a 2% deductible. Well, that's $8,000, versus the standard $1,000 or $2,000 deductible. So you want to pay close attention to these details. I'm going to take a look at your replacement cost, what it costs to rebuild your home today versus what it cost 5 or 10 years ago. Definitely going to be a difference there. And you want to take a look at something called extended coverage, where it would make up for the gaps left over by what's not covered by replacement cost. You want to make sure you have sewer backup, septic backup, water backup. A lot of people find out in a very difficult way they do not have this coverage. It's not a standard policy. It's an add-on, and you don't want to come home from a hard day at work or maybe even a week of vacation and you find several feet of raw sewage in your basement. Even if you have this coverage, take a look at the amount and make sure it's adequate. If you have a finished basement, it just got finished last year, and you've put a lot of money into it. It's not a cheap project at all. Well, if you just have $5,000 of coverage and they have to replace flooring and replace drywall, it's likely to cost much more than that. You can also take a look at service lines, water lines, septic or sewer lines. They used to be a separate policy altogether by separate companies, and now many homeowners insurance companies offer these as add-ons to your homeowner's policy. If one of those goes bad, let's see, a sewer line goes bad, and they have to come out and dig up your yard, that could be very, very expensive. Wouldn't be unheard of to hear quotes of $8,000, $10,000, $12,000. The lines are typically several feet below the surface. They got to bring heavy equipment in. It's not a cheap project, so take a look at that, add it on if you do not already have it. If you have any type of, say, expensive jewelry, that could be something you want to add on to it. It's not a standard policy. Diamonds are very expensive. Whatever type of jewelry you have and you've sunk your hard-earned money into, you want to have coverage for it. And if your homeowner's insurance is not escrowed, if you have a loan that does not require escrow, and we often see this with conventional financing, if there's more than 20% equity in the property at the time of loan origination, you don't have to have escrow, tax, and insurance. Well, you never ever want to let that insurance lapse. If you do, then you're going to have what's called forced placed insurance. It's very expensive, and it does not protect your personal belongings or provide you with liability coverage. If you have a condo, now the condo association maintains a master policy, and that master policy will have either a walls in or walls out type of coverage. With walls in, it would imply that inside the condo is protected. Well, probably so with, say, standard builder features, but say you had upgraded renovations done, it may not cover that. It's not going to cover your personal belongings, and it's not going to give you liability coverage. So don't assume because you have walls in coverage that you do not need homeowners insurance. So be sure to discuss that with your insurance agent if you are buying a condo. If you happen to receive a notice of flood insurance, and from time to time I've had clients reach out to me and, hey, what's this? I got a notice of flood insurance. I've been here for 10 years. I've never seen any evidence of a flood. Well, look, FEMA is the one that maintains the flood maps, and they do change over time. If you do receive that notice, if it were me, I would look into an elevation cert. They're done by engineers, and that may reduce the cost of the flood insurance or eliminate it altogether. To give you an example of a client I worked with a couple years ago, bought a waterfront home, and he told me without the elevation cert, the flood insurance would be $18,000 per year. With the elevation cert, it was $1,800 per year. So it's a very worthwhile investment to have an elevation cert. While you're reviewing your homeowner's insurance, you also want to review your auto insurance. And the minimums required by each state for auto insurance may leave you in a really difficult spot if you have an accident. And there's two points I want to make here. One is uninsured motorists. There's something like 30 million uninsured motorists across the US. Two states, Virginia and New Hampshire, do not even require auto insurance. And even in states that do, there's a lot of people out there driving without insurance. If you're involved in an accident with someone and it's their fault, well, if they don't have insurance, it's going to come back on your insurance. And so you want to make sure you have adequate uninsured motorist coverage. So discuss that with your insurance agent. Those state minimums, again, could not nearly come close to, say, covering your hospital bills or covering damage to your own vehicle. If you also are reviewing auto insurance, you want to take a look at the liability coverage of your policy. Again, those state minimums. If you're involved in an accident and you are found at fault, your vehicle could be paid for. It's a 20-year-old car. It was paid off 15 years ago. All you ever need to do is oil change and tires and brakes. It's super reliable, gets you where you need to be. But you're involved in an accident, you're at fault, and it's a brand new high-end vehicle just off the lot. It's not uncommon to find cars out there on the road right now that are $100,000 or more. Well, if your coverage is only up to $50,000 and it's a $100,000 vehicle, guess who's going to be on the hook for the rest? So you want to review these with your auto insurance agent. Just make sure you have adequate coverage there so you're well protected. Simple adjustments to your deductibles may even keep your premium the same or close to it, but greatly enhance your coverage. If you are a landlord, you own rental property, you want to take a look at landlord policies. They can provide protection in the event of rental loss. Say the property is damaged, maybe caught fire and your tenants have to move out and they can't live there while the property is being repaired, renovated, you're going to have rental loss, and rental loss coverage can protect you against that. Also can provide you coverage in the form of liability if tenants were to sue you, or say someone was hurt on your property. So make sure you have adequate coverage there. Make sure you have coverage, period. I had a client years ago I was working with on refinancing an investment property, and when we're working on a mortgage for someone, of course we have to get the insurance agent info. And when I asked about this, he told me, he said, well, the tenant takes care of that. I said, well, my experience, tenants don't take care of homeowners policies, they take care of a renter's policy. This gentleman was under the impression that the renter's policy was the same as the homeowner's and he was the one paying for it. That's not the case at all. Fortunately, nothing bad happened to the property or there was any type of situation where he needed liability coverage because he effectively had none. So we quickly had him add on a homeowner's policy to protect his asset. Last thing I'll leave you with is look into an umbrella policy if you don't already have one. They pick up where homeowners insurance or auto insurance policy are at their limits. And again, for a small investment each month, it could greatly protect you in the event of an issue in the future. And you don't want to be in a situation wishing you would have had insurance that could have protected you. And it takes a little bit of time on the phone to review all this with your agent. So I encourage you to do so. If you have any questions, if you want to connect with me, click on the link tree in my bio or the description below.